You can support this podcast for $3 a month at patreon.com/copytradersclub, or find me on eToro, username Gavin Macaulay, and add me to a watch list for future content. Thanks for listening. Copytraders Club, where you can learn how to make better decisions and more money copy trading. I'm Gavin Macaulay, my name and username on eToro. Today, we talk to a PI who has been having a strong 2022, having pivoted from long to short, and is growing in popularity among copiers. Here we go. Season 2, Episode 40 of the Copytraders Club podcast, and as always, my aim as an eToro enthusiast is to demystify this new and uncharted world of copy trading, understand what are the pitfalls and best practices, and how ultimately to succeed as a copy trader. In chats like today's, the aim is to answer all your questions about this popular investor, and reveal more about them than anywhere else, so you can assess whether they might suit you. We experienced numerous challenges with sound quality at both ends, unfortunately. I've cleaned it up as best I can, so I hope it doesn't cause you too much aural displeasure. The sound quality does improve as the conversation goes along. In this episode, we talk to Jim Booth, whose very memorable username is B3130jim. He's a student of history, navigating these paradigm shifts by adhering to the principles of Dalio and striving, as George Soros would say, to stay ahead of the curve. Driving around the curve of the sweeping cobblestone driveway of the impressive Copytraders Clubhouse is the limousine we sent for him. And here he comes. Jim, hello. Welcome to Copytraders Club.
Hello, Gavin.
I don't know if you've listened to many episodes of the show, Jim, but in order to get past security, you need to answer a series of quickfire questions. Ready for those?
Yep.
Username on eToro.
B3130jim.
Date you joined eToro.
October 2020, I believe.
Date you became a popular investor.
February 2022.
Year of birth.
1973.
Place of residence.
Works up north of England.
Profession.
Trader.
Briefly state what you aim to achieve on eToro.
I aim to achieve the best risk-adjusted returns for copiers and also for my own portfolio.
Name one of your investing heroes.
Undoubtedly George Soros, although Ray Dalio's a close second.
Name one of your favourite investing books.
The Alchemy of Finance by George Soros.
That completes the formalities. Let's proceed into the VIP section now, here at the Copytraders Clubhouse. The splendid Copytraders Lounge awaits you.
Great.
James Alexander Booth, aka B3130jim. Are you ready for this magical transition?
Yes, I am.
All right, Jim, come on through. Take a seat here on one of these magnificent couches. Can I get you a drink or anything?
I'm fine, thanks.
Okay, well, I thought a man like you would maybe have a little whiskey or something.
Oh, I could be tempted.
Or is it too early in the day?
Always nice whiskey, always nice.
Okay, so Jim, you're in Worksop, which is somewhere in the Nottingham area.
That's right, North Nottinghamshire.
What do I know about Nottingham? Not very much. Obviously, Nottingham Forest, back in the Premier League.
Yeah.
Is that exciting for you, or you don't care?
Too busy on the investment front, really. I do follow the football a little bit, but investing's a full-time passion, so yeah.
The only other thing I know about it is it's the ratio of women to men is quite favourable, apparently.
Supposedly.
You can't attest to that.
Yeah, people used to say that with the lace mills in Nottingham, but I think it's sort of evened itself out over the years.
Okay, so let's talk about you. You're an experienced investor, obviously born in 1973.
Yeah.
You're the first guest who shares my year of birth.
Oh, right.
So that's good. So this is not your first rodeo, it's fair to say.
No, I've been through a few booms and busts in my time, yeah. So I started when I was a teenager. I was sort of given some shares, and in the lead up to the 1987 crash, everybody was, in the there was all the privatisations, Margaret Thatcher, the stock market was booming, everybody was buy, nothing can go wrong. Shares are a great investment, and then the crash came in 1987, and at the bottom of the market, everybody was, don't touch shares, they're so dangerous. I wanted to sell. My parents were like, oh, don't sell your shares. I've got a friend who was doing a similar sort of thing, so we both sort of held on, but we both realised at that time that the very best buying opportunities were when everything was negative, because after 1987 the stock market took off like a rocket.
Wow, so you learned some very important lessons very early on then when you were 14, 15 about buying when there's blood in the streets. That's excellent.
Yeah, absolutely. Yeah. And then again in 2000, when the dot-com boom happened, I waited that out, and then bought it again at the bottom, or somewhere near the bottom. I didn't quite get that one perfect, but I bought when valuations were good after that. But I didn't partake in the dot-com boom. I didn't buy those technology stocks. I missed some of them on the way up, but again, like I say, I look for the risk-adjusted return, and if companies aren't earning real earnings, then I don't partake in them. Just like this time with the technology boom, I wasn't in it going up, and I'm definitely out of it and short of it going back down. But the great experience is to have watched how far out of kilter markets can become in a boom, and how far they'll drop on the other way.
Right, well, we'll get into all that stuff a little bit later. For now, let's go through some of these introductory things. Let's talk about your username. Now, a lot of eToro users live to regret the username that they entered when they first signed up. I imagine you're in that category. B3130jim.
Yep. So I didn't realise my username would be up there. A lot of accounts, when you log in, it's just a username, so it doesn't appear on the screen. So I wasn't too concerned about that. But anyway, it's unique. I don't think anybody else has got one.
It is unique. It doesn't exactly roll off the tongue. Or you can imagine someone down the pub saying, oh, you should check out this guy called... I can't remember what he's called. It's all numbers and letters.
Yes. Yeah, well, anyway.
But the good news is eToro seem to be shifting focus away from usernames and more towards real names. Like when you go on your profile now, it's James Alexander Booth, also known as or whatever, is in smaller letters beneath.
That's a much better idea, yeah. Real names are always better than usernames.
All right, so let's talk about how I came across you, Jim. I suppose it's just a story of the changing of the guard. You know, a lot of the big PI names kind of have been declining as the market has completely shifted. And a series of new names keep popping up everywhere on the Discover page. And, you know, when you search for people who are trending and all the rest of that, your name kept appearing. You've been featured a lot on the Discover page, I think. You can correct me if I'm wrong. It does no harm that your 2-year return, which is the statistic they show, is very healthy.
Yep, so I did come across eToro several years ago, and I did think about coming on eToro, and they said that you got paid for people to copy your account. But to be honest, I couldn't believe the amount that people were getting paid to have their accounts copied. So I didn't think there was much merit in it. I'd never thought that eToro would be paying so much money to allow people to copy your account. Otherwise, I would have come sooner. But anyway, I'm here now. So, yeah, it's a good place to be, good platform. And, I hope I can get great returns.
Okay, well, let's get to know you a little bit better, Jim, when I ask you to tell us something you're very bad at.
Oh, well, I did ask my wife, but she said she's still doing the list. So D.I.Why, undoubtedly. Putting shelves up in the garage just recently, unbelievable. So I took them back down again. Going to get somebody in to do that. Yeah, I'll stick to trading.
Well, DIY is one of these things, like if you're not taught it by your old man when you're a kid or something, or a kindly uncle, it's all practice. So if you don't know what you're doing, the thought of being able to do it well first time, forget about it. It's always going to be a disaster.
Yeah, I think it is. I think when you're young, you learn things in a particular way and it stays with you. And the people who are good at it do things at 13, 14, 18, 20 when they're young, and you learn those skills and they stay with you. Whereas, my dad was never a DIY, and I never even learned how to put a screw in. So, but my mum always said, look, be good at one thing, that's all you need to be good at. So, I chose to specialise, and I did specialise, and hopefully, it has paid results, to be fair, what she told me.
Oh, yeah. Interestingly, I think D.I.Why is going to come up when we chat later about a few of your key positions.
Oh, yeah. Kingfisher.
Okay. So, yeah, D.I.Why. That's a good answer. That might be my answer to that question also.
Yes.
All I can do is paint. I can paint pretty well. Paint walls.
Good, yeah. I still get criticism for the painting, but I'm getting better.
Well, you're a married man. The criticism is the game.
It is definitely.
All right, Jim, I'll ask you now a question from the art of people. Can you give me a number between 1 and 10 that isn't 7?
8.
Other than a member of your family, tell me about your role model.
Role model really is Ray Dalio, I would imagine, at the moment. Fantastic perception of history, really encouraged me to go down the history route, that these cycles repeat themselves again and again. And that fits in with my own experiences. So, his free book, if anybody's interested, you can just download it free from his website, Trading Big Debt Cycles. We've been here before. It repeats and it repeats and it repeats. And read his books and that book and his insights, and history is the biggest tutor.
Let's turn our attention now to your bio on eToro. If I could ask you to read your bio from the start down to the words focused on safety and performance.
I'm a professional investor seeking great companies at a low price relative to their potential. However, I implement a range of strategies depending on market conditions, including shorting the market to profit from falling prices and trading forex and commodities. I seek low risk and high return opportunities. I aim for a risk rating of 5 or below. I hold an honours degree and am studying for a master's degree in safety and risk management. I have over $70,000 of my own money invested in this eToro account. You can therefore be assured that I'm laser focused on safety and performance.
So you're a professional investor. This is all you do apart from studying?
That's all I do. Yes.
And has it been all you've done for a long time?
Not for a long time, no. I did work part-time for a while. So for 4 or 5 years, I've worked part-time and then studied and invested.
And you have an honours degree and you're studying for a master's degree in safety and risk management. What does that entail?
So that involves the assessment of risk. So it's with Heriot-Watt University in Scotland, and a lot of the course is geared towards the safe operation of things such as oil rigs and chemical plants. So it's quantitative and qualitative risk analysis, so using numbers and systems to analyse risk within particularly complex systems. So complex systems are things with lots of different moving parts. But it's also very useful in terms of analysing markets, because markets are a complex system, and cause and effect aren't necessarily linked. So if you think about an oil rig, a small change can cause a huge amount of difference. So with, say, the Piper Alpha accident, you had some divers that left a mat underneath a pipe, and the oil leaked from the pipe, pooled on the mat. The mat then caught fire, which caused the Piper Alpha sort of the start of a huge change within the system, within the oil rig. So again, it's like a small change can lead to a very large change within the whole system. So cause and effect in complex systems is not necessarily, they're non-linear. So you can get a small change, say a bankruptcy of one bank can cause a whole run on all of the banks, particularly when you've got what's called thinking participants. People think about it and think, well, I'll move, and their actions then influence other people's actions, and then a small change can cause a large change.
That's all very interesting. Is the purpose of you studying that for your investing career, or for general edification, or for future career, or?
So I used to have a background in food safety and health and safety, so it was risk management in things like food factories and health and safety in those sorts of things. So, I was involved in factories that produce sort of millions of units of food, where one small change could contaminate potentially tens of thousands or hundreds of thousands of meals, or cause an accident, or strike the system out. So my background has led me to that, but it also has come in incredibly useful for the deep theory in terms of analysing things like nuclear accidents. So, in things like nuclear accidents, the more safety provisions that you put in place actually can impinge on the safety of the operation. So, having more warning lights or warning sensors that can actually give false signals can actually cause more confusion and actually lead to a breakdown in the whole system. Like 3 Mile Island, lots of false warning lights caused confusion, triggered the wrong responses. So, in terms of setting your stop losses and what safety positions you put in place to manage your safety and your risk, you need to think very carefully about that. This idea, you just put a 10% or 20% stop loss in, I think it's not bad for a starting point, but as a finishing point, you need to try and think about the system and where it's at the moment. If it's near a market bottom and things are really good value, then you might want to just operate slightly differently to you would if you were chasing a trend and you were up towards the top of the trend. So if the market was very high, then you might want to operate a slightly different approach to managing your risk than if it was very cheap.
Okay, let's have a little look back over your results then. As you said, you joined in 2020. Your first month is September. So you had a few months then. Big gains. November was almost 50%, in December like 14 something, which gave you a 2020 figure just in a few short months of 73%. Presumably you weren't playing with a huge amount of money then, or you weren't planning to become a popular investor at that stage, were you?
I had over $50,000 in, I think, at that point.
Okay, so what you're suggesting is that we shouldn't discard 2020 results. They're as real as any of the rest of them. The point I'm trying to make is a lot of times when people start on eToro, they play with a small amount of money, they take loads of risk, they get big results, but we can ignore them basically because it was just fluff and fun and they didn't care what happened. think what you're saying is you had a fair amount of money in, and these results are to be viewed as genuine and not discounted for those reasons.
Absolutely, yes.
And you weren't trading in any sort of different way than you do at the moment?
Not at all. No. I mean, I was looking for great value stocks, so no change in strategy. Great value stocks at a low price, low risk, big upside, and some sort of catalyst that would cause that. So at some point, I knew the vaccine results were going to come out. There were, I think, 4 or 5 vaccines in that at that time that were in phase 3 studies, and I knew within the next few months they would be coming out. So all it took was one vaccine out of the 4 to succeed, and I knew I would get results of sort of 40-50% upside.
Okay, and then 2021, you've got an annual score of 64.5%.
Yeah.
And 2022, year to date, 5.77%. So despite a very short track record on eToro, you've already secured 2 big annual scores and then a positive so far in 2022. So well played.
Thank you. Yes. So the dip this year was really transitioning from long to the market giving a signal it wasn't going higher. So I stayed with the market long, rode the trend up. Then the market started to break down. I saw the signals, exited, and went short. So the dip this year, where I think I lost about 12%, was that transition in terms of, okay, the market's given the signal, close out long, let's get short. It's always the most difficult to sort of ride the trend to the end, get off the trend, change direction. So we changed direction, we've jumped cars, we're going the other way now.
Looking through your history, it seems like a lot of your success from 2021 and into 2022 could be attributed to, well, I suppose, events in Ukraine, significant wins in various oil companies, Calon Petroleum, Occidental, Whiting, EOG Resources, Schlumberger, and Petroleo Brasileiro. You also made big gains from military stocks like Halliburton and Senior PLC. So do you subscribe to the view that when the bombs are flying, you'd better be buying?
Not at all. Ukraine didn't change anything for me. The bet was on an oil shortage, and Ukraine was something of a catalyst. But that oil shortage, while ever the economy was growing, they weren't going to be able to pump enough oil to meet it. So Ukraine gave it a kicker. But for me, I'd rather Ukraine didn't happen and the cycle continued. Ukraine introduced a new area of uncertainty in terms of would there be peace or not. To me, the Ukraine war didn't seem to make too much sense. Why would you fuel inflation and plunge most of Europe into an energy crisis rather than reach some sort of agreement or settlement in Ukraine? So it didn't seem to make too much sense what had happened. And from then on, I was quite wary that the Europeans would want to make peace with the Russians over Ukraine because so many people are suffering relative to a small amount of gain or loss for Ukraine. And a lot of people in those areas of Ukraine would want to be with Russia, or a certain portion of people there would have been. So the Ukraine war was a bit of a black swan and a bit unexpected that it has persisted so long and that so much money has been poured into it while so much of Europe and European industry has been shut down. It doesn't add up to me.
Okay, so and then let's talk about how you transitioned. Would it be accurate to say that this year has been a story of good gains from the stocks that you were long on earlier in the year, and then transitioning out of those long positions into an entirely short one, which you have now at the end of the year?
I'm entirely short and I intend to be short. So looking at the 2000 dot-com boom, that bear market took 2 years to complete from top to bottom. I think we're in for something like that. It will take about 2 years for this. The 2008 credit crunch and the bust that followed, that was again a 2-year process. So I expect there to be significant gains in bear markets. Most of the gains, or as it was, the losses for the market as it drops, are geared at the end. So just like in a bull market where you start getting a new uptrend, they start off slowly, build momentum and accelerate. And so with bear markets, you get a sort of a topping process, and then it becomes apparent that we're going to have a recession, earnings start falling and they accelerate, and the share price follows the earnings. So as the earnings decline, accelerate, I expect the share price declines to accelerate.
We'll talk about market outlook a little bit later. Let's just carry on through some of these main eToro metrics for now. Your risk score, let me describe it to the listener. You're pretty much average 5, max 5, I would say, overall for the past 12 months. A lot of people have seen their risk scores lip up. I think you said in your bio you were aiming for risk score of 4, is that correct?
5 or below.
5 or below. Okay, so you're within that. Copier numbers and assets under copy. As of the day of recording, your copier numbers are 2,321. And your assets under copy, all I can see is between 2 and 5 million.
Yeah, round about 2.5 to 3 million, yeah.
And let me think, your copier graph, it's a very steep rise initially, followed by a bit of a decline, then another little rise, then more of a decline, and then another steep rise. Have you been on the Discover page multiple times?
The Discover page makes a lot of difference. The main thing that makes difference is your performance. So when you're performing well, they put you on the Discover page. Unfortunately for copiers, that tends to coincide with, if I'm short, then the market's made a new leg lower and we're towards the bottom end of that leg. People tend to then copy when you're already at the lowest point of that leg. What I would say is, if you're going to copy and somebody's short, wait until there's a rally, because as George Soros says, markets proceed in a wave-like fashion. So they don't just move in one direction. They move 2 steps one way, 1 step back. And the time to short is actually not when the market's overextending in one direction, wait for the step back. I do regularly write that. So when oil prices were going up 21, 22, I was trying to encourage copiers, don't sell out on the dip. But a lot of them seem to get nervous and sell out on the dip and then miss out on the extension on the next leg up and rejoin again. So, yeah, in a bull market, try and buy the dips and don't lose your nerve. Copying's not as easy as it first sounds. The main thing to do is pick somebody who's good and be patient and have confidence in them.
Yeah, I think copier behavior tends to be that anyway. They copy it at the top and then stop the copy at the bottom. So there's an added layer of complication when you're trying to sort of reverse that when you're talking about the market, because you're a shorting PI.
Yes.
Okay. Trades per week and average holding time. Let me see. Trades per week, it says 5.5. Average holding time, 5.5 months. Not sure what sort of story that tells, considering you've gone from long to short. Or your short positions, you're not really in and out of short positions either, are you? You tend to hold those for quite a while.
Yes, I think that was because of the transition from long to short. So I would say I do try and hold for a longer period of time. So I would expect that holding time to draw out over the next sort of 6 months to a year. And extend out towards sort of 12 months or plus.
Okay, and let's talk about communication. Is eToro the chief way that you communicate with your copiers? I see you're also pretty active on Twitter.
I do some on Twitter, but yes, eToro is my main way of communication, just because everybody's got access to it who's influenced by my actions.
And do you have some interesting debates in your comment sections about things that you're shorting, or people making suggestions to you should short this?
I do get some suggestions, and some of them are good, some of them aren't, but I've had some useful suggestions. I've had a second look at some of them that people have suggested. Yeah. It's always good. That's one of the advantages of social media and social trading.
And what is the frequency, you would say, of your posts on eToro?
Every 12 to 14 days. Every 14 days would be a good estimate. I do tend to write quite long posts, sort of 2,000 to 5,000 characters. So, yeah, longer than average anyway. And I try to put information about the market rather than just reiterating the market went up today because of this or down because of that. I try and provide a broader picture of how I think about the boom bust cycle, about the trend that we're in, and just try and provide a bit more information to copiers. If we've had a bounce in a bear market, try and think about the larger trend that we're in and look at the trend and post some charts so that people can see it's the bigger picture that counts and not to be put off by short-term moves. I think a lot of people think because the market went up, say, 10% or 5%, that there must be a big reason for that, but that's not the case. Bear markets, they're full of moves of 10, 20, 30% the opposite direction. You have quite sharp snapback moves that ultimately fail, and then you get very sharp drops afterwards. So it takes a bit of nerve to trade bear markets, but the gains can be good.
I've got in my notes under communication the term one-on-ones. I saw somewhere you were offering to communicate with people directly or something. What's that?
So if people wanted to understand more about the market or my thoughts, then we were doing some one-on-ones over Zoom just to talk to people about how to trade. I'm a big disciple of George Soros, Ray Dalio, the boom bust cycle, so that's working really well. If people wanted extra information about that, then I would talk them through the boom bust cycle, talk them through the charts, talk about technical analysis, talk about the signals that I use to help them copy or to help them with their own trading. So yeah, I did make that offer.
Okay, so you're in a sense a macro investor and a long-term holder of assets, and then you switch when you think there's an overwhelming case that the market is turned and is going in the opposite direction. Now, a lot of people on eToro, they're sitting tight with what they bought. They're long-only stock investors, and they're just waiting for the tide to turn. Why, in your view, is that the incorrect route to take?
You have 10-year periods. So if we look at, say, the 1960s, you had a boom in technology stocks, things like Hewlett-Packard, all those sorts of technology stocks. They were up at similar sort of, not as extreme multiples as today, but fairly extreme. We then went into the 1970s, rising interest rates. Those stocks over the 10-year period from the 60s to the 70s lost about 70% of their value. If we look at the technology boom going into the year 2000, again, the next 10 years, technology stocks lost about 70% of their value. They were perfectly good technology stocks. They just became wildly overvalued. So the secret is don't get caught. After the boom comes the bust, and then something else will lead. So you've got to look for the new leadership group now.
Do you copy?
Do you copy?
Do you copy?
Do you copy?
Copytraders Club.
Copytraders Club.
Do you copy?
Do you copy?
Do you copy?
Do you copy?
Copytraders Club.
Copytraders Club.
Okay, now let's turn our attention, Jim, to your portfolio on eToro. Let me describe it a little bit to the listener. Asset class allocation isn't terribly complex. Stocks 78%, ETFs 22%.
Yep.
You've got 14 positions and a cash allocation currently of 30% you're keeping in reserve. Is that... Well, talk us through your cash position.
So because I'm short, eToro doesn't use all the cash. So when you're short, you just put the margin down, which is 20% of the value of the position. So it shows us quite a large cash holding, but it's not. The actual exposure is for the full 30,000 that you see sat there. It is actually working. You just have to put 20,000 down, and the rest is sort of I keep in reserve in case the positions move against me. So, like I say, if you've got a £10,000 position and you go short, eToro charges, I think you have to put down 20% margin. So you've got a £10,000 position, you would have, say, £2,000 of that cash would show on your account as used, and you would have 8,000 of that £10,000 sat there looking like unused cash, whereas really it isn't. It's actually part of holding the position.
Okay, so this applies when you have a sell position. It doesn't apply to things like buying SQQQ.
No, when you buy SQQ, that's fine. Or if you trade a CFD, then a CFD you would only put down a portion and the rest would show as spare cash. So you can't short and use your whole amount of cash, which I would like to do, to hold the short position. So eToro makes you so you can only use 20% of the cash and the rest is sort of financed by eToro.
I always like to have a little look at the desync issue. There's very little desynchronization going on between your invested and your value column, even on assets that have significantly increased or decreased in price. So this must be something you monitor and take action on. You do a lot of trimming of positions and raising and lowering depending on how well things are working out, or
it's probably that I haven't moved very much at all. So for many months, you wouldn't see much of a change in the allocation of the portfolio. So if people copy open positions, then everything should stay in sync.
The biggest desync is in very small positions like Aston Martin, where you've had a 62% increase, and what you currently own is 1.42%, and what your invested amount is 0.89. Even that's not significant. Okay, so Jim, let's talk then about your market outlook, where you think things are, where you think things are going. Maybe we can start off, or as we do so, I'm going to quote some of your tweets and then allow you to expand on those. That might be a nice way of structuring this. First tweet is, what the weather will be like in the next 2 weeks, I've no particular idea. But I will bet that in 3 months it will be significantly colder. Same with markets. I don't know what will happen tomorrow, but I've got high conviction in 6 months stocks will be much lower.
Yes, I think that sums up my approach to markets. I don't think you can know what's going to happen tomorrow, but I think you can understand that over a period of time, what central banks do in terms of putting money into the system or removing it from the system will influence stock markets. I think stock markets are a correlation of how much money is available in the system, and if you remove money from the system and make money more expensive, i.e. so interest rates are the price of money. If you make interest rates higher, then the price of money is higher. So people will look elsewhere, less money is available in the system, and you will see money move into other asset classes. So when people think about the stock market, I think you've got to think of it as part of the financial system where it competes against other assets. So for 10 years, you've had very, very low interest rates of sort of, say, 1%. If you could get, say, 5% in stocks, then stocks look extremely attractive. If you were to move interest rates up to 5% and stocks were to yield 5%, then stocks become extremely unattractive because you're exposed to risk in stocks. And so we've seen one of the sharpest moves higher in interest rates in history. And all of a sudden, stocks had to compete with interest rates of 1%, and the next thing they're having to compete with a 2-year bond yield of about 4%. So you can get 4% at zero risk now. So that's a huge headwind to things like NASDAQ and technology stocks, where they became very expensive. But the forward returns as share prices move up actually become lower. So if you've got something that, say, costs a share that costs you £1 and the return on it is, say, 10 pence, all of a sudden, if the share price goes from £1 to £2 and the return is still 10 pence, then the yield is halved. So there's been a huge move up in the NASDAQ, but earnings haven't kept pace with the increase in the stock prices. So they become very expensive. So now we've had the sharp increase in interest rates, and a lot of money now is flowing into fixed income because of the security of the returns, and it's a much more attractive risk-adjusted return. And that's been the big headwind against stocks. Plus, now earnings for stocks are falling as we head towards recession. So the return on stocks is actually falling, and the risk-adjusted return looks a lot less attractive.
You mentioned earnings. Here's another tweet. After the boom comes the bust. It's amazing more people aren't seeing that tech earnings will disappoint for many years.
That's true, yeah. Again, it's exactly what happened in 2000. You have a boom. During that boom, there's a lot of investment in new companies and new competition. So you get a lot of new competition. And the next thing, you raise interest rates, everything slows down, and you've got overinvestment, overcapacity, and then you get the fall in stock prices. And as we're starting to see now, what lags the boom is the fraud cycle. So frauds are starting to appear and begin to get exposed. We saw FTX, the crypto exchange, valued at over 30 billion, and it's gone completely. So we'll see these frauds start appearing in NASDAQ and technology stocks soon as well. And I think the bigger the boom, the bigger the fraud cycle. So be prepared for the impact on stock prices, that people will lose confidence in the reported earnings, and that companies are actually solvent when they say things are going really well. People will start to doubt them. And I think Tesla will move into that type of area where what George Soros referred to as the bias. So you can look at a glass as half full or half empty. During the boom, the glass is half full, or it's 3/4 full. People get so carried away. During the bust, people look at everything very skeptically. It's not very easy for companies to get finance, and that actually influences a company's chance of success.
Okay, so Jim, you're sounding the warnings loud and clear, telling us to beware. Talk us through, what's your market outlook then for the next 6 months? How do you see things playing out with the Fed, interest rates, earnings, the housing market? Is it all pointing one direction?
So the thing that drives the housing market, the first indicator is rising inventories. So new home builders can't sell the houses that they're building. So you get a sharp rise in housing inventories. We've seen that now. So then these houses accumulate on the market, and that slowly at first starts to pull house prices down. So because banks lend, and during good times when house prices are rising, banks get positive feedback. They say, okay, we lent you so much and we're earning great money, because even if people can't make the repayments, we repossess the house. The house has gone up in value. We haven't lost any money. So they look at other banks who would be more aggressive with the lending. They then step up their lending. The lending actually causes the increase in the asset prices. So the act of lending is actually a self-fulfilling prophecy. So the more that banks lend, the higher the house prices go, the better the results on banks, the better the results on home builders. But when you reach the inflection point, house prices fall, banks think we're losing money, lend less, which then furthers the cycle and creates the bust phase, where the more house prices fall, the less that they lend, the more house prices fall.
Okay, so that's the housing market.
And pretty much stocks. So when we had very cheap money, you could look at margin debt. So the amount of money that people were lending to put into the stock market, that was also a record high. As interest rates go up, obviously that amount of money going into the stock market reduces, and the market starts falling and people get margin calls. And again, you see that process, not just in the housing market, but surprisingly to a very, very large extent in the stock market. If you could get money at, say, 1% and stocks are returning 4%, then, lend money from a bank at 1% and put it in the stock market at 4%. And that's what's happened. It's caused a huge boom. And you can look at the historic valuation ratios for particularly the bubbles being concentrated in American equities. And you can look at it, and they're right up there with 1929 values, 2000 values, and 2020 are pretty much on a par. So we're on at least sort of up there with the three highest valuations we've seen in the last 100 years. at the moment on US equities. So US is the centre of the bubble, and that's where I focus most of my short positions.
You're talking about measures like market cap to GDP.
Yeah, and price to sales ratios, market cap to GDP, price cyclically adjusted PE ratio, so the Schiller PE ratio. Yeah, so you can look at PE ratios, but at the peak of a boom, those PE ratios are pretty meaningless. It's what they are over the cycle.
So what are you expecting from Jerome Powell going forward?
I think eventually, we are getting to the point where we do get a pivot, but the history from the 70s is once you get high inflation, it does tend to not fade away very quickly. So I do think the recent inflation number was a bit of an outlier. I'm surprised it caused so much such movement in the market. But I think he's got to hold interest rates at quite a high level. So he's talking positive real interest rates now for quite a long period of time. So, 2% will inflict some real damage. He's got to get unemployment to increase. That's the thing. He's got to get unemployment up because the labour market's too tight. So once unemployment goes up, then people are forced into selling, and that's what forces the bust cycle in effect. People have to sell assets, houses, and money will become a lot tighter. So remember that the interest rates work with a long and variable lag. So the interest rate rises, they might not, that we've had so far, a lot of them won't kick in for at least another 6 months. So there's more and more headwinds coming towards asset prices.
So you're expecting quarter 1 and 2 of 2023 to be when the real fireworks start, whenever the effects of the interest rate rises really kick in. By then, some of these other key economic indicators, as you mentioned, employment, that could be different by then, the housing market, earnings forecasts.
Yeah, I mean, if you look at charts of earnings forecast, they're all sort of 80 to 90% of earnings changes now to the downside. So we're on that change now where earnings are on the downside. Companies are reducing spending, they're reducing investment. And that'll filter through the system. And the interest rate rises that we've had already are still working their way through the system. So a lot more to come, the early stages of this trend.
I was going to ask you, are you on the bearish side of the argument that suggests that inflation might actually drop very quickly because of the fact that all these lagging indicators aren't showing the real story, but they'll be unavoidable very quickly, and things like employment numbers and the housing market are going to deteriorate so rapidly that the cure for high prices is high prices, and inflation will naturally drop quite quickly. Not that that's to say we're going to snap back into a wonderful environment. There's still dozens of problems to face, and the recession is, without doubt, almost upon us. Or are you more of a mind that high inflation is going to continue for a prolonged period? It seems the latter from what you just said.
I think he's going to hold them there for quite a long time. Inflation's not going to go down very quickly. The history from the 70s is it took quite a long time, like more a period of a year or two for inflation to start moving down. People's wages haven't kept up with inflation, so I think while the labour market's this tight to retain employees, you're going to have to keep on offering them more and more sort of higher wages. So there is a lag.
And what about the political pressure that might come to bear upon him to cut rates because of the national debt in the States? Is he going to be able to hold it high for long?
That's the $1 million question, isn't it? That's the $1 million question.
That's why I'm asking you, Jim. I need to know this.
Okay, so he said he doesn't want to be known as the Arthur Burns. So in the 70s, inflation started to pick up. Arthur Burns was the chairman of the Fed. He took his foot off the brake too early. Boom, inflation came back with a vengeance. No Fed chairman wants to be known as the Arthur Burns. They'd rather be known as the Volcker, the guy who stepped on it hard, reset the system, a renowned Fed chairman throughout history. So I can't know exactly what political pressure is on, but he'll never be forgotten if he turns out to be the Arthur Burns. So the incentive for Powell is to be the Volcker and squeeze inflation out of the system. And that will mean a nasty recession like the type of recession that we saw in the early 80s when Volcker squeezed inflation out of the system, which was a long, protracted recession with a protracted period of high unemployment. Unfortunately, I don't want this. Don't pin it on me. It's unfortunately mistakes that have been made in terms of believing that inflation was transitory.
So what do you think of the bullish argument that it's only a matter of time before Jerome Powell pivots? It might be coming quite soon. We'll be back at the races. Look at what happens when good news filters through. There are many players that are yearning to put their money back in, it seems. There's a tremendous keenness for people to get back to winning ways. Are they going to be victims of bear market rallies and lose their shirts? Or is there enough positivity among them? Is there enough of a window for the stock market to actually do okay for the next 6 months?
So the bear market of 2000 and the crash of 2008, they were cutting interest rates aggressively all the way down. So from 2008, interest rates were sort of 5%, cut all the way down to pretty much was 1%, 1.5% less. Same in 2000, from 5% to 1%, cutting all the way down for 2 years. So don't pin your hat on interest rate cuts saving you. The 2000 crash was sort of 80%. Technology shares fell 80% from peak to trough. And the 2008 bubble was mainly focused on housing. So housing stocks, banks, I mean, you would be looking probably 80% of a collapse in most of the value of the assets that were the epicenter of that bubble. So again, in this bubble, the epicenter is technology. I can't see why you're not looking at sort of 70 to 80% off the Nasdaq.
Okay, well, that's a suitably bleak note on which to move on to individual positions, if we can, in your portfolio here. I think the first one to talk about then, given what you've just said about your view on the prospects for the Nasdaq, is SQQQ.
Yeah.
Now, I'm not an expert in shorting. I've played, I'm quite bearish myself, or I'm convinced, I should say, by bearish arguments more than bullish ones. But I've yet to sort of, I don't want to mention having a pair of testicles or anything, but I'm yet to convince myself that it's time to bite the bullet and go short. And I'm not quite sure what the best way of doing so is. Which brings me on to this question about SQQQ. First of all, it's a triple leveraged inverse ETF trading off the underlying asset of the Nasdaq. To provide this exposure, the fund uses swaps on QQQ, swaps on the index itself, and futures. Now, you're happy to hold this for months. You've been holding some of your SQQQ position since June of this year, and now we're in November. So I want to ask you, why is it you hold this instrument rather than the indices themselves?
So when you're short, you have to pay financing on your position. With SQQ, it's actually a long position. So if you're short and you're short something at 100 and it falls to 50, then you would make sort of a 50% return. If you're long something at 50 and it goes to 100, then you make a 100% return. So the problem with being short is the maths of being short. So it's better to earn something which is inverse, that goes up as a percentage if the market goes up. And also the 3 times leverage is cheaper with the SQQ. The financing cost is much, much less than holding, say, 3 times as much of a long position in an ordinary Nasdaq trade. So I could go QQQ and leverage it up 3 times using eToro's financing facility on a CFD, but the rolling charges on that would be much, much higher than the SQQ position.
How about the argument that SQQQ is a trading instrument which is meant to be held for a day or two, perhaps a week, because it decays over time due to the volatility drag which arises because SQQQ resets each day. They only match the daily return, not the cumulative return. You know all that whole argument.
I know that argument, but that is less than the cost of the financing charges, withholding 3 times the leverage. So eToro would charge you, and so would any broker, for financing charges. So the financing charge on the SQQ, the difference, it still favours holding SQQ over holding an ordinary short position.
Well, because I was reading up on this prior to our chat, so I could understand it more fully. Like, why would Jim hold SQQQ for weeks and months if it decays so much? And I was looking at your positions. Maybe you can help me. If we look at an individual position, yeah, if I go into your SQQQ, I can see the 30th of June position. You've been holding one trade, or maybe 2, on SQQQ since the 30th of June.
Yeah.
Since the 30th of June, the NASDAQ has dropped something like 10% at the time I made my notes. So you'd expect an inverse ETF with 3 times leverage to have been a big winner in that time. Yet those positions are red in your portfolio. Why is that?
Right. I don't know, to be honest.
Well, isn't that because of the decay? Like, I was reading and people saying, if you hold these things for months, if you hold something like SQQ for months, you will end up with a losing position.
Right. Okay.
You've got to be in and out on a far shorter time scale.
Okay, I just looked at the SQQ position and I was up on it, so...
No, I mean the individual trades. Like, if you go into your individual trades on SQQQ.
Okay. I was aware of the decay. My working on the financing charges was that SQQ costs were lower than financing charges, but I'd have to have another look at that and see why that's happened.
Yeah, I'm not saying anything definitive here. I'm just trying to understand it myself.
Sure. I did know about the decay. It is more extreme. I did read about the decay. I did know about it, but I didn't realise that it was... And I did read other people's opinions on it, and I didn't think the decay was that sharp, to be honest. So I might have to tweak those and review my trades on those. If I've held them for that long, they should be handsomely in profit. All I was looking at was SQQ on my account overall was showing decent profits, so I hadn't followed the individual positions that closely, but the decay must be more than I expected.
Yeah, it's quite confusing, this whole resetting at the end of the day thing. I wonder, should I try and explain it? I've got some notes here. I should maybe try and explain it, should I, to the listener? The reason we're talking about this is because SQQQ only matches the daily return, not the cumulative return. So if the NASDAQ goes down one day and up the next day, finishing overall flat over the course of 2 days, your SQQ position will be in the red. The longer you hold it, the more opportunities there are for decay, meaning it won't match market movements overall. It's a trader's tool, not an investor's tool.
Yeah.
Okay, well, let's move on from the complicated issue of shorting indices to perhaps the more simple issue of shorting stocks. I would like to go through some of your positions, Jim. Well, first of all, let me describe your top 5 according to your invested column. Tesla, SQQQ, Kingfisher, Beyond Meat, Rolls-Royce. You're selling everything apart from SQQQ, which you have a buy position on, which we just discussed. So you're short on all of those things. Well, let's talk about Tesla. That's a common stock for short interest. How much further has that got to fall?
So I was looking at some numbers, and the short interest in Tesla, when I started shorting, it was about 2.5%. So very slight short interest. I think it's built a little bit, but it's still quite low. So Tesla's an auto stock, and auto stocks trade at less than 1 times book value. Tesla trades at many, many times that. So established auto stocks like Mercedes trade less than 1 times book value. Tesla's worth more than Mercedes, BMW, Toyota, Honda. You just keep on adding them up. I don't think that makes any sense. As Tesla, as a sort of a niche auto maker, high end of the market, as we're already seeing, it's already starting to exhaust demand. So the valuation is based upon that Tesla is a market leader in self-driving and numerous other technologies. I think it's now fallen way, way behind things like Waymo, a lot of the Chinese auto manufacturers, brilliant cars, world leaders, I think now, not Tesla. So I admire Elon Musk. People say to me, oh, you must hate Elon Musk. Well, I don't. I actually quite admire him. He's a pioneer. He took on the industry. I think he's an innovator. But I think the rest of the industry has woken up. We're finding that inflection point like we saw with Netflix, where Netflix was the market leader. All of a sudden, you've got Disney, you've got everybody else pouring money in, and we get the big slowdown and earnings take a hit, especially as we're going into recession.
Harking back to what we talked about earlier now, when you painted the picture for us of you struggling to erect some shelves, Kingfisher is a UK business. It's a home improvement company. It owns B&Q, as in you can do it when you B&Q it. So what's the rationale there? Post-pandemic reality setting in, high cost of materials, less demand, dropped like a stone this year.
Yeah, so also I think the big disruptor, you've got very large warehouses, the heating bills, but also the internet. The internet is destroying big retailers. You walk into B&Q, half the stuff there you can get dropped off at your house now by Amazon the next day at a lower price. That's the big destroyer of Kingfisher is the internet retailers and a coming recession. So I think the COVID boom and the lockdown, people brought forward a lot of their sales. People went out, did the houses up. The houses are done up now. Plus we're going into a recession, plus the internet. So we've got 3 or 4 quite powerful factors that I think are going to continue to impact Kingfisher. They do have the Screwfix, which is much smaller stores, but I wonder to what extent the Screwfix stores are cannibalising B&Q stores as well.
Interesting, yeah. Yeah, seems like they've got a lot going against them right now. So from the very prosaic shelf erecting Kingfisher to luxury vehicles, Aston Martin, its share price has also been on a horrific decline for some time. You've been involved in that for how long?
Oh, a bit too late with that one, but...
It's still on the way down, but they say invest in what you know. You've probably got an Aston Martin sitting outside in the driveway.
Definitely not. That company's been bust 3-4 times or more in the past. I think that tells you everything that you need to know. They've floated off on the stock market, dumped it on the stock market at the top of a bubble. And there's accounting issues there in terms of depreciation charges. All of a sudden, the way that they've depreciated some of the vehicles and the investments, it all looks very, very much like this is heading towards bankruptcy, plus a recession anyway. So, you've got I always look for multiple factors when I short. So not just, we're going into a recession, I'll short that. It's like, this business is not a good business. It's got a bad history. Car manufacturers, it's a scale business. Niche manufacturers are always really, really going to struggle. And time and again, you've seen that with Aston Martin. I don't think this will be any different.
So what's the next James Bond going to be driving if this goes tits up?
Yeah, probably a German vehicle, I would imagine. Something like that. BMW, yeah, we've had that before.
I think one thing that all of those positions have in common is that, as I sort of mentioned, they've all been on a large decline, and you seem to get in when they're already on the way down. Is that you look for momentum on the way down? Is that right, before you enter?
I look to identify the leaders. So if markets were moving up, I'd look to identify who the leaders were. So on the way down, who are the weakest? Who's the market's telling me the weakest, and do I concur with them? Yeah, I look for the market to give me the signals this is weak, like Aston Martin, and then look into the history of them. And yeah, I mean, the slight exception is Tesla held on for quite a long time. It did stay quite high for quite a long time. But eventually, I think people are starting to realise competition's coming on its way, and we can look at the numbers on Tesla in terms of deliveries really slowing down, the backlogs disappearing. So, yeah, there's quite a few signals there. I've made an exception with Tesla, but Tesla's now accelerating to the downside, I believe.
Tesla's share price has always been quite divorced from its economic reality because of the weight of fanboys,
Yes,
among other things. But yeah, you think the retail investors have a world of pain coming to them?
unfortunately, yes. I think there's a big lag with Tesla. In bear markets, that's where you face reality. In a bull market where there's lots of money going around, providing things go up, people buy it, because I've heard people use the term the new religion is market fundamentalism. So if the market says it's good and it's going up, then people believe that. And I think that's the psyche of a bull market. It goes up, I buy it. In a bear market, there's sort of a delayed reaction. People believe in the bounce, people hold on and hope. And then at the end, you get the final phase, which is capitulation, which is where you get the biggest drops towards the end, where people throw the towel in. And I think we'll see that with Tesla.
Yeah, they say the last 25% happens very quickly.
And towards the end, of the bear market, yes.
Okay, another thing you're obviously not a big fan of, which is also quite appropriate for the moment we're in, is crypto. You're also shorting Coinbase and MicroStrategy. They're your 6th and 7th positions, I think, with mixed results. Oh no, they're both up massively. It was mixed whenever I made my notes. See how quickly things can change. MicroStrategy, or one of them was down. Must have been Coinbase. Okay, so obviously not a fan of crypto. There's another tweet here which might be worth quoting. Tech hodlers and crypto bros need to realize there's no baby in the bathwater.
That's true, yes. Yeah. So the other position that I'm short is things like Beyond Meat. It's symptomatic, really, that of the whole tech boom, rising losses coupled with rising revenue. So revenue's been going up with Beyond Meat, and every year you get bigger and bigger losses. And there's quite a few companies like that, surprisingly. So how are these things going to finance themselves when money tightens up? The same with like MicroStrategy. The more that crypto prices fall, so MicroStrategy basically holds an awful lot of crypto, and some of it's financed with debt. So once we cross that threshold, there are numerous margin calls which will be made where they've got to actually sell Bitcoin to pay to hold onto their existing Bitcoin. So I'm always looking for sort of triggers like that, which will be force the share price even lower, and then the lower it goes, the more they have to sell, and the more they have to sell. And Elon Musk's personal debt is structured like that with Tesla shares. So if Tesla share price drops below a certain level, Elon Musk has to then raise more capital. Well, his main source of investment is Tesla shares, so he's got to sell more shares to hold on to his positions. So that's why I think we accelerate with these sorts of things. Once we reach a certain threshold, we'll get an acceleration.
And just quickly, do you have a view on the extent of the contagion that we're going to see in the crypto space in light of FTX?
I think it's big, unfortunately. Crypto was sold as a deregulated space, and if there's one upside from it all, it's that we see the value of proper regulation. Crypto was sold as get away from the corrupt bankers and the corrupt system. All it did was really open the door to the crooks, unfortunately. I feel for a lot of people who've been caught up in this, who were sold something that wasn't. But I'm sure now the regulators will start trying to play catch up. We'll see some regulation come in, but in a way, the regulation sort of destroys the crypto story, that you can have a system, a monetary system without government. But of course, governments create money, and governments have had a monopoly on money other than gold for a very, very long time. We've moved beyond that, and we've seen what's happened. So, I mean, ultimately, in maybe 10 to 15 years, when the dollar gets in a lot of trouble, they've got a lot of unfunded liabilities, maybe crypto will make a comeback. But I think it's going to be one of these for the next 10 years where, technology does poorly for the next 10 years, like I was talking about the 10-year sort of cycles. And I think crypto will really, really suffer. But, I was listening to somebody talk about crypto, and they were talking about the number of 80-odd% declines, and then we get another leg up, and then an 80% decline. And the history of crypto has been very, very large declines of 80-odd%. So, once we get down to those sort of levels, I might just cover some of the shorts and just get cautious a little bit before, because you never write crypto off, but it's serious damage in confidence in crypto. Yeah.
Okay, let's switch gears, Jim, and talk about your copiers then for a second. Who should copy you?
Anybody who's got confidence in me. I think people who copy you should have a similar philosophy and viewpoint. That's why I write quite long posts to try and explain to people, this is my viewpoint, this is how I trade, and this is what I think. And if those people can sort of think, actually, that's what I think, then I think that's good for copying. I would really struggle to copy somebody with a totally different viewpoint to me. I would be too much on edge. So if you like what I say and you like my opinions, then copy me. But if you've got big doubts and you think the other way, then don't.
Well, that was going to be my next question. Who shouldn't copy you?
Yeah, anybody who's got a very optimistic outlook. I think you'd be too cautious, and you'd think, well, I haven't got much confidence in this guy. When you get the bear market rally, you jump off too soon. So,
is there a right way or a wrong way to copy you, Jim?
I think the right way to copy is, if you've got confidence in me, to add when the portfolio has the bear market rallies, which make the performance look poor. So add on the bounces. Don't do what most copiers do, which is get panicked. Add a little bit more if that's suitable for you. Whichever way you copy, try and do the opposite. So if in a year or two, we get to the bottom, we start a new bull market, buy the dips. Don't get panicked. Don't, dips. In a big uptrend that lasts many years, you will always get dips. It's just in the nature of markets that when a trade becomes too crowded and everybody's long, and all the commentary in the newspapers will be positive, everybody's in, you will get the reversal, and you get stuff 20 to 30% cheaper buying dips. Likewise, with the bear market rallies, add a little bit, or get your entry point on the bear market rally.
This is a very difficult time to be a copier. I mean, with all these market fluctuations, up and down, bear market rally, are we back? Is it roaring again? All these questions. It's much better for a copier, isn't it, to stick with the PI and let the PI sort of manage the market movements. It's quite hard for a copier to be able to time it exactly like that. So I think you're talking about two pieces of advice there. One is don't get spooked by bear market rallies. It's a great piece of advice, I think, for your copiers. Obviously, if they have the wherewithal or the confidence to try and add at the most appropriate times, that would be great. But I imagine for the most part, sticking in is the more important piece of advice, right?
Yeah, and phase your entry points as well. So don't think, okay, I want to go all in on this copy now. Build a position over 2 or 3 months, because every couple of months, it seems like every 3 or 4 months you get the rally, the change of direction. So I think copiers need to look at some sort of history of trend, some typical sort of a model of a trend, which is an up wave, 2 steps up, 1 step back, 2 steps up, 1 step back, that sort of wave-like movement higher. So once you're aware of that, you're much more confident to actually, I'll just add a little bit on this dip if we're in an uptrend. Likewise, if we're in a bear market, just sell into the rallies a little bit, and that's what the pros do, sell into the rallies if you think it's going down. Don't get too spooked.
So what makes you so special, Jim?
No, absolutely nothing. all I'd say is I've seen these cycles before, and I study a lot of history, and I'm not perfect. Always trying to learn and always trying to do better. So I think if I've got an advantage, it's I like to be humble. I like to have a learning approach to markets. I've got plenty of books, and I've got plenty more. So big history fan, and I think that helps see things in the context of what they are. These cycles repeat.
And what sort of resources do you use?
So I use SharePad, which gives me the earnings. So it gives the history of a company's earnings all the way back, charts them out. That's about £25 a month, but it gives you the forecast earnings, which are currently lagging. So you have to be a bit cautious of those types of things at market inflection points. But SharePad. I like Seeking Alpha. Twitter, some really good stuff on Twitter. I'm some really competent people on Twitter. Things like the bond market, which I'm not brilliant with. I'm not a big bond investor, so I'm learning off some of the best bond investors in the world on there. Yeah, so there would be my main sources, but I tend to stay clear of newspapers. Newspapers follow convention, and they miss all the big inflection points. So newspapers tend to be confident at the top of the market, very negative at the bottom of the market.
Are bonds among the things you might consider buying into when it's time to become a buyer again?
Yes, very much so. Yes, I'm very, very much eyes on bonds at the moment. I need to make sure that Powell's going to hold it till the end, though. That's the $1 million question. Is he going to hold his foot on the brake and really squeeze this inflation out? Because if he doesn't, then you could get caught out. I don't see inflation going much, much higher here in the States. I think we are at that stage where we are moving towards the top. But inflation's, once it gets entrenched, as we've seen with the politicians, there's too much money in the system, but politicians want to bail people out and give them more money to help them through the difficult periods and the rising prices, which is itself inflationary, and that's exactly what we saw in the 70s.
What changes would you like to see on eToro?
So to speak bluntly, I really don't like the idea with eToro that it defaults to, on some instruments, 20 times leverage or 10 times leverage. So when you go on to some of the oil, then it automatically, you don't have to click. It doesn't start on zero leverage. It starts on some sort of crazy number. That, to me, is very questionable. I think eToro should move away from that pretty quickly.
Very good. I don't blame you for saying that. Any other changes to user experience?
I think it's a great platform. People share ideas. Generally eToro, the account's well run. You get a statement at the end of the year showing your gains and your losses. So lots of good things. But I'm particularly not the account support. I've always had fantastic. I think it's a good platform. But the default is a bit of an issue for me. When I started, it did catch me. I was busy one morning, and next thing I thought, blooming heck, I've got some movement in this. Luckily, I picked up on it pretty quickly. But it's a point of concern.
Okay, what other PI would you say you know best on a personal level?
I don't know the PIs. On a personal level, if I was to copy somebody, then it would be somebody you interviewed. I can't quite remember his name. It's the guy who trades currencies he used to trade them for a bank. I think you've interviewed him.
Analysis Cyclical?
Spanish guy, yes.
Yeah. Jose Sabalegui.
That's right. I would copy him because currencies are a diversification for me. So I do trade currencies a little bit, but again, I like his style where he's using waves and he's buying dips in terms of cycles. He seems experienced, and copying him would be a diversification. I think he's competent. So I haven't looked into him massively, but I think, I think you've got something going on there.
Well, he's doing very well at the moment, as are you, of course. Were you down at the Popular Investor meetup down in that London?
No, I wasn't actually. No, I wasn't. But I did intend to go. But the next one I will attend. Yeah, definitely.
So have you ever seen a popular investor in the flesh?
I haven't. No. I do follow the rankings pretty closely, I have to say. Yes. I haven't gone to any of the face-to-face meets. No.
Or you don't know of any other in the Nottinghamshire area?
I don't actually. No. We don't. I haven't looked that closely at it. I mean, people seem to be from all over, or mainly Europe, but pretty much all over the world. So I haven't really thought actually there could be somebody quite close to me who's also a popular investor. I just look at things in terms of a limited amount of time. So if I can listen to, say, the world's best guy on bonds or the world's best, balance sheet analysis on a podcast, if I've got an hour and then I've got an hour to listen to the best in the world, or one of the best in the world. So I'll spend my time always trying to listen to the very best people in the world on each subject.
So you must listen to every episode of Copytraders Club then?
Absolutely. Some good people, yeah. I mean,
All right, final question, Jim.
Yep.
What's the one question you wish I'd asked you during this chat that I haven't?
I think mistakes are the most interesting thing. I think mistakes are the thing where you hit those inflection points where you don't know something. So you mentioned SQQ, I've never been a big derivatives fan. These are relatively new types of things. Yeah, mistakes are the most interesting. And I'd never want to be a trader who says, I got this right, I got that right. I'm far more interested in what didn't I get right, what don't I know, where can I learn more than that. So, yeah, I always think my most interesting things are things that I got wrong, and where I learned, like I said earlier, every day is a school day, and realising you don't know everything is a good attitude to have, So I'll be listening to podcasts today and reading and on Twitter trying to learn new stuff, yeah.
Well, that is indeed a good attitude to have, Jim. And listen, congratulations on your success so far. You've done excellently on eToro.
Thank you very much.
I will be watching your progress with interest as the market does whatever the heck it is it's going to do over the next couple of quarters.
Thanks for taking the time for the interview and great talking.
Well, you're very welcome, Jim. Appreciate you dropping by Copytraders Clubhouse and the very best of luck.
Thank you very much. Take care.
Gentleman Jim Booth there. Many thanks to Jim for paying us a visit. Jim is one of the few PIs on eToro who has shown he can be both responsive and directionally right, both in bull and bear scenarios. If you can do that on eToro, it seems pretty clear that the copiers will reward you handsomely. We watch Jim's progress going forward with great interest. That's all from me. See you on Discord and Facebook. Until next time we meet at Copytraders Club, I wish you many happy returns. Obviously, anything you hear in this podcast is for entertainment only, not financial advice. Do your own research. This is just generic chit-chat. We don't know your individual circumstances, etc., and so forth.